Hello everyone, welcome to our next webinar, why you don't have to be afraid of investing, and especially nowadays with the hype of Corona, this is a very important topic to discuss, and you probably have seen the news.
It looks ugly out there, at least for equity investors and for those who haven't looked out there yet today. Oil prices has dropped by the biggest since the Gulf War in 1991. Other equity markets are down yet again. A lot of parallels being drawn to the financial crisis of 12 years ago. And we will, without spoiling it too early, but we will actually talk about that a little bit later and try to put things in a longer term perspective. But for a moment or two, let's turn to something a bit happier than the current market situation.
Happy International Women's Day to all of the great women out there. Yesterday was the big day, and it kind of like continues in several countries over this week and the whole month of March. So we wish you a great and successful month and year and everything to come. Just a few words about this year's International Women's Day, which is under the topic of each for equal, which means actually that women should stand up for other women and help each other to perform, to become independent and to drive for what they feel is important to them in their own life. So do your bit, get started, inspire others in whatever you do. Is it in becoming financially independent with us today a little bit more, or for anything else that you believe in, motivate others, stand up for others and help each other. So for that, let's start getting into our topic for today. And I'm pretty sure many of you have thought about or think about some of these messages on the slide here about, I don't know where to start with investing, or I'm afraid of losing my money, especially nowadays. The markets are not looking that good, quite in the red area. Or you just don't know enough about investing and therefore don't feel comfortable to get started. But don't worry, you are not the only women out there who is scared about it or thinks about these hasty thoughts. So stay tuned. We help you to not be scared. We help you to understand the market and to understand how you can feel much more comfortable about investing. But let's look at a few stats for now. 85% of women actually deal with money on a daily expenses or day-to-day investments, which is quite a lot. So women have a huge impact in their financials on the daily life. But why are we not actually taking the money in our own hands when it comes to the future plan? So this is something we looked into, and here are two sobering stats. One is that 60% or almost 60% of the women defer the money to their husbands or spouse, and actually even more shocking are the 82% here, where women believe that the men know more about finances.
Now, is that really true? Let's have a look.
But before we get there, here are a few life challenges that make, of course, the life of a woman a bit more difficult. One is definitely the gender pay gap, the unpaid work. So there is actually 2 times more time spent by women on unpaid work compared to men. But only 1/3 women are spending less on paid work. So overall, women are actually working more if you combine the unpaid and the paid work compared to men. Women also work 2 months of a year for free. So this is actually quite shocking to me. We work more, we usually invest more time in unpaid work, but we are actually paid less. Women live longer, which means our money has to hold for a longer time. In average, on a global scale, this is 4 to 5 years. And 1 in 7 women actually challenge to care of a child and an elderly relatives at the same time. So this is also due to the growing and elder generations, and our parents get older. we, as mainly the women in the family, then take care of both of our kids plus the female in like the elderly parents or relatives. So this again will drive to the fact that women reduce on work, they go more into part-time, or they choose a job which is less paid and they are a bit more flexible. So these are all things that impact us quite a lot. And one of the last facts is, of course, the divorce rate, which is not impacting the man at all. It's also impacting on the male side a lot. But we have to make sure that we also have, for these cases, our independence ready.
So, chaps, a lot to chip in on our front, if you listen to that. But now let's turn to the question I asked earlier and look at that, sobering that is for us. Women are statistically actually better investors than us, or at a minimum, they're at least equally successful. And maybe also not to be dismissed, is they invest with positive impact.
Which then also leads to the fact that if women invest their money, they actually have a huge impact on the world and on the society and the whole environment. So women will educate their children more. It's still the fact that even girls get less pocket money than boys. So these will definitely change if the women have a different relationship to money. They are bigger role models because family and friends are actually the first go-to point for women if we have a question around money, which is actually quite shocking. So being a role model in the money area is very important as well, and you will impact women around you and make them and help them to be motivated and independent about it. Women invest usually more sustainable. The economy will be supported by that fact. They will mobilize others. They will invest in corporates done and led by women. So there is a huge, huge impact that women will put into the market when investing and getting the confidence to take care of their money.
That all sounds good. Now, let's have a look at practicalities. Because at the end of the day, it's all about getting started, doing something actually with your money. And one of the first decisions, or one of the big decisions to make after you decided that you do want to get started, is what do you invest in? And typically you would start with deciding in which asset class or which asset classes. And we've given you some examples here. We've given you sort of returns over the last year. And now it's all easy, isn't it?
It sounds, but how do you get started? If I now have, for example, the first year, I take a year to look at what could I invest in, like we have in this example. Is that enough? Probably not.
1 year is not enough?
No.
All right, I give you 10 years. Let's see if that makes your life
10
easier.
years.
There you go. Is it any clearer now?
Not really. It's just a very colorful page here. But this exactly shows that it is very, very difficult to understand the numbers, to see what do they tell me. And they actually don't tell me a lot. But if I would now guess, let's take the best performing, because I can assume that maybe that one still keeps continuing getting better. So that would be here at the top left, the dark green.
That's a good choice. That is what is called the MSCI Emerging Markets. What is that? That is a broad-based stock index that covers emerging market equities. And that in 2007, remember, we're just talking about around the financial crisis. It sort of started in 2007, got really bad in 2008. So let's see if that would have been a good choice.
I personally believe emerging markets will grow. So let's see if
have a look.
The fact.
Let's see.
Ooh, that makes quite a big roller coaster here. Up and down, up and down.
It is all over the place, I think it's appropriate to say. Now, my turn. I do believe, despite of what's happening in the equity markets and has been happening over the last few days, I do believe in the longer term potential of equity markets. And I will also venture outside of Switzerland for a moment, and I will put my money onto the S&P 500.
Let's see. A bit less.
Doesn't look so shabby, does it?
A bit less.
Okay.
But the facts in the last few days showed something different, right?
And that's exactly where we want to put things in perspective. Needless to say, it's been really, really bad. We don't know. We don't have a crystal ball either. We don't know where markets are going to go from here. It seems that the reaction is much stronger than it was in other situations where we had virus infections and other health issues around the world. It doesn't seem as bad as the financial crisis. That's among the worst that we have seen in recent history. But what we do and what we can do is look at this parallel that's been drawn and is being drawn over and over again over the last few days, which is the financial crisis, which is exactly those years that we're looking here. Now, let's make it a little easier.
So if we put that in an overview, that's what we get.
That is what you get. So imagine you had invested in 2007, and imagine you would have invested in, let's pick something, the S&P 500 to stay with my most
which is the orange one,
which
no,
is
the green one.
That has actually performed the second best over that period of time. And remember, it's been really, really bad. 2008, it crashed down all, substantially, 40–50%, but it then subsequently recovered. What you had to have is patience, though. Or you would have been maybe lucky or very knowledgeable about markets, and you would have been able to pick the lowest spot. Then you would have even performed better.
Which is almost impossible.
It's hard. For the average investor, that's extremely hard to do. But even for professional investors, it's very hard to do. This slide shows a couple other things, for example, that we are also seeing, or have been seeing in the last few days, which is different asset classes react differently to crisis. Stock markets plunge at the same time. Fixed income markets, and particularly government bond markets, go up because people put their money in what they perceive as safe. And a lot of people believe that gold is the safest place to put your money, and you can see that here as well. Gold has had an absolute stellar performance after the first 2 years after the financial crisis, and then it dropped off a cliff as soon as people felt more comfortable again. So what is the conclusion of all of these lines and all of these numbers effectively? I think it's twofold. One is, if you do have a longer time horizon and patience, equity markets, although they seem daring and scary at the moment, still return and did return in the worst financial crisis that we've seen in a few decades, did return among the best of different asset classes. And secondly, diversification is king. Without a crystal ball, it is important that you split your risk across different asset classes.
And that's already 2 of our 5 tips that we have for you. Maybe the 3 others I quickly cover as well. I think
Sure.
The education. I don't know enough about money, or I don't know how exactly investing works. These are definitely questions you will have. These are questions we have, or I definitely had when I started investing. Important here, I think, is you don't need to know everything. Yes, you need to know a little bit, as much as you can feel comfortable about it. That probably the level is different for everyone. If you don't want to get that deep, try to find a trusted partner early on, or go to different markets, go to different banks, get different information, and then you can also start understanding different inputs you get. Ask questions. Always a good thing. Never shy away of asking stupid questions. They are never stupid. Ask whatever question you have with whomever you talk to about investing. Money. You don't need to have $1 million to start investing. There are many markets or many products out there where you can start very early with a few bucks a month. For example, ETFs, the exchange traded funds, is a way to start with a very low amount of money. The ETFs are also very positive in the event of diversification. So you invest in multiple companies, in different products, and that helps you already diversify in a very easy way. So if you don't have at all money on the side, let's say with some ETFs and robo-advisors, you can start with $2,000. If you don't have that maybe ready already, then go and start saving to it, which is also possible. Start just putting every month a little bit into a fund account or a fund depot, and that will help you to build up your wealth. Understanding the stock market. Yes, it will go down like it does now. Actually, it's probably a good time to think about getting on track and start, hitting into the market to then ride the wave when it goes up again. Be patient. Really, if you start investing in the stock market, be patient. Put only the money in that you can accept, not accessing it for the next 8 to 10 years. So don't put money into the stock markets that you might need in the next 1 or 2 years, but more on a long term, and that you can have there lying there and working for you for a longer time period. And the other two, the diversity and the time, which is covered. If you still feel uncomfortable about it, and if you still feel it kind of give you an initiation, but you're not sure how to continue, then maybe, if you are in Switzerland, we can happily invite you to our next workshop, which is next Wednesday. We will cover the same topic, not being afraid of investing, but we will look at the different investment opportunities in the Swiss market. So we will look at the different accounts or depot solutions, robo-advisor, whatever is out there, to discuss which one might be the right one to get started for the different budgets available.
And we will have more time to go into more detail,
exactly,
rather than just covering the the very bolts and nuts of it as we did now.
Other than that, you will find much more content on our website, where you can read through on your own time. You can sign up anytime. And otherwise, we're looking forward to welcome you for the next webinar, where the topic will be all around sustainable investing and how you can invest with a purpose.
And hopefully markets will have somewhat recovered by then already.
Hopefully.
All the best for you. Have a great week, and we look forward to seeing you again.